Today is May 10th, 2019. This is a new concept for the Resilient Advisor podcast that we are calling Forecast Free Friday, where our goal is to help you build a more informed portfolio through the lens of math, history, and behavioral science. Joining me for this project is Clint Sorensen, the CIO of Wealth Shield. Our plan for these broadcasts is to keep them short. No fluff, no ads. Let's get to it. Clint, tariffs. What's your take?
Yeah. So a perfect example of you have no idea what's going to happen, right? At the end of the day, our base case was that we get some sort of trade truce, that nothing really meaningful would come out of the deal. It would be really politically motivated on the short run. And then we'd have some continuation to work together long term to try to negotiate the harder items. It's kind of our base case estimate, right? But again, showing you cannot forecast, right? So Forecast Free Friday is a great theme for this particular case. We wrote about it on Monday in our paper titled Long Shots. We were talking about Kentucky Derby, right? A 65-1 horse winning in Country Home, which was or Country House, whatever it was. But it was a fascinating scenario that developed there. We had the first disqualification since 1968, and then Sunday night, President Trump tweets that we're increasing tariffs to 25% on the first batch of goods from 10 to 25, and then on a whole another set of items, 325 billion worth, from 0 to 25%. So that was a meaningful deal, and then those went into effect this morning at midnight as they continue to have some trade talk. So, look, I think it's politically beneficial to have something develop here. I'm not a big fan of tariffs or taxes, but I've got to trust that our president and his administration knows better than I do on these topics. So again, and from our opinion, from a behavioral opinion, it just humbles us because it gets us back into realizing that we do all suffer from overconfidence bias and we don't put enough of a probability on these outsized events. And I think that's why the market's reacted the way it has.
Yeah. Another big event was Uber pricing last night on the low end. It'll start trading here in about 45 minutes. Just talk generally, you don't have to be specific about Uber. I'm just curious about the IPOs that we've seen here recently and the implications for investors building portfolios.
Yeah, I mean, I'm not a big fan of IPOs in an investment portfolio unless you're getting in some sort of special pre-IPO deal. Where the IPO or shortly thereafter is your catalyst to sell. And that's more of a transaction than a long-term investment strategy. Look, some of these companies over time will be worthwhile to add an investment portfolio and a diversified investment portfolio. But I try to make sure that the people we counsel, which are advisors, that they let their clients understand that this is a lot of hype. Right? They are running around, they are selling the idea of their business. The fact they're pricing on the low end means that they're not getting the consideration they'd hoped for, right? And I don't think the market's ready at this point in time to absorb that size. And so I think it's going to be interesting. Beyond Meat was fascinating, right? Seeing Beyond Meat shoot to the moon reminded me of the 99 days, 99, 2000 time period where IPOs came out and doubled or tripled. And so you just never know what you're going to get. Like Forrest Gump says, you just have no idea. And I think at the end of the day, it'll be interesting to watch. But I tend to recommend that people stay put. Don't get all wrapped up in the hype. Get to where you can measure and map their business and their rate of change in terms of how they're growing, and then make an educated investment decision. Don't let FOMO push into the IPO market.
Yeah. I had started my career in the mid-90s, so I got to experience that internet bubble firsthand, both from my own investment account, but more importantly, seeing advisors working with investors that got caught up in it, and it had disastrous outcomes for people building retirement portfolios. If you got caught up in the hype and you were nearing retirement in 1999, boy, you had a really, really tough start to the century.
That's right.
So let's wrap up with talking about one of our favorite topics, direct indexing. So just in case there are viewers that don't know exactly what direct indexing is, could you explain it at a base level and then talk about why you like direct indexing so much?
Yeah, so I love, there's a lot of different takes on what direct indexing really is, right? But our definition is you buy the underlying constituents of an index. So an index provider sends you essentially each underlying constituent, every corporate action, everything, and you're buying those underlying companies in an individual account. So that's what we, as the index weightings prescribe. right? So there's a lot of index replication strategies out there where they say we're direct indexing, but what they're really doing is they're taking a subset of that index, optimally weighting it so that it tracks or has a low tracking error. But our definition is actually purely following the index, every single position, every single holding.
And we can do that today because of technology. So
yes.
How does that work for an advisor?
Yeah, so the advisor, you can use several UMA unified managed account platforms, or think SMA platforms. And on these SMA platforms, you have actually these index providers that have relationships with the platform. And so they send their positions to the platform. Platform then puts those into an SMA. Advisors can link up accounts to that, and then through that technology, invest their client accounts in those direct indexes.
Yeah. Now's the time for it. It is the future of investing. The Wealth Shield team put out a white paper on this topic. I'll include this in the show notes. Clint, thanks for coming on again.
Thank you.